S&P Futures rally on a short week. Nasdaq holds one critical level and rejects another. The VIX continues to implode while the dollar rallies. Tesla, Meta, and others reject a critical level that must be overtaken. Small caps quietly outperform on the week. AFRM, CVNA making higher highs every day of the week. Smart money, dumb money has done this only 5 times in the past 25 years. We'll explain what it is and why you need to watch it. Margin debt as a percentage of growth crosses the zero line for the first time since breaking. This is the 5th time in 20 years. We'll explain what it means. We have a ton to go over. Let's get to it. Hey everybody, welcome back. We can see the 46.2575 level, 46.30 level right up in here. And we've been stuck in this range for some time now. 3 weeks down, we can see that pretty clearly in here. It's not something that we really want to pay that much notice of. The other day it was funny. I mentioned that this looks like a cup and handle. The amount of comments that it's not deep enough to be a handle. Look, don't shoot the messenger. We got up here and then all of a sudden we very simply just rejected. It's pretty clear that we rejected. I would not rule out that you're probably going to make some kind of retest here at this point. And we're going to get into what happened on Friday, which stocks sold down, why they sold down, what to do when we come into Tuesday. There's a lot going on here that we're going to go over in some great detail. But I do think that it does pay to just pay attention that, okay, we dropped for about a month here. Well, we've done that before, haven't we? And then we've had periods of time where we've gone sideways. So I wouldn't rule out that this was just a little pullback before we push higher. Now, that said, let's just look at the basics. And we'll just start with the moving averages. 22, 55, and 12. That is what I use here on this weekly chart. You should use whatever you're comfortable with. I like using these. There's several reasons behind it. I may do a video on it eventually, but I like doing the educational videos and weaving them into the content. And then maybe I'll just clip them all out. But you can always comment on that and let me know what you think. But we are back above the 12-week moving average, and that is pivotal. We had to make a decision. We broke it. We stayed under it, and by the 3rd week, we're back over, and we're challenging it again. And I think that everybody should know this, but I think you may have already noticed that one of the core things that's happening here is that when we trend sideways like we're doing, more people are noticing that they're getting stopped out a lot. Well, when you start in these little bases that you have here, which you've been in since roughly June, you're coming back to that area, and you're basing and you're bouncing around, you have different players at different locations. You're going to trend a lot sideways, and you're going to get a lot more opportunity to get into those charts that you weren't able to get into before. That is very different than when you're just doing something like you've been doing since March, which is just pushing higher. And you can see how it's kind of interesting because you can see how you broke right here, and you just flipped right over it, and it's a nice point of confluence right in there as well, isn't it? So I think that's a very important distinction that you need to be aware of. Now, if we flip to this back on the weekly, what else is this telling us? Well, we're seeing the RSI here, and you can see how that RSI is starting to turn up again right there, and that's something that we're going to want to pay attention to, because if the weekly starts curling again, well, that's very different than the drop that we've had. And if we look at from when we've had this drop on the way down, so you just basically just draw a line straight down from there, you can see when we cracked. Well, we've cracked, we worked off some of the overbought, not all of it. We didn't get back to that neutral line, which is what you would prefer to do, but you didn't do that. And now you're starting to curl back up. And that's what's important. The trajectory of this is important, and we're heading back up. This is a weekly chart. You don't want to rule that out. If we spend the time and drill into this on the daily and use the same moving averages, which I do, then we're going to note that we are above the 12, we are above the 22, and we are above the 55. I'm getting a bunch of dojis up here, and I'm going sideways on the RSI on the daily. I'm not sure if that's happening for a couple different reasons, but I think it's worth pointing out. For example, the one thing I think we need to take a look at here on the index is we did get above the control bar, and we're staying up there. We never, ever came down 50% of this bar and challenged any of it. Never. We just ripped, and that was it. The 50% line on this would be 44.73, just FYI. You always want to look at 50%. It's pretty simple as to why you want to do that. Right? If you have a bar, it really represents a day, of course, because we're looking at a daily chart. And if you can't even get through half that, it means that you have more buyers than sellers. Don't overthink it. Now, period of doji, and you're trying to get through, but you're not. Very light volume on Friday, more to just cut people up than anything what was happening. But this is where you're at. So are we going to rally? Are we going to get back up here? We're going to have to just watch and see how this thing plays out. I do think that there's something pertinent that I do want to go over here. If you do draw up in this level, you'll also see that there's a slight level in here, and you kind of have a band more than an exact level. You kind of have an area in here, and you can see how you got chopped up in there. And I just think it's important to note that we broke that here, where we got chopped up in this area, and now all of a sudden we're not getting chopped up in there anymore. That area is becoming support. And that's something that we should note. We should also note that we are seeing certain stocks move higher and certain sectors move higher that we haven't been seeing. But before we get into that, let's get into the Nasdaq and some of the things there that we've been talking about. So number one, I'm sure everybody else already saw this, but let's just drop that level because we can see up right in here how that was resistance, and it's no longer resistance, is it? So we can see this level right here, and that's 15.437. So that might be something that you want to watch. Just call it 15.4. You're in that area. You just want to see if you play in there. Look at the demarcation line. You could even use the low of the doji right there. This was your control bar when you broke down. You obviously reversed. You couldn't get any lower. We talked about that earlier. And then this level held as well, and I think that's a very important distinction. So if you come across, you just look, well, you held. We broke. Right? And then you have your little evening star right here. For anyone who watched that candlestick video, there's your evening star. Undercut here, not a true piercing pattern, but then you work your way up. And this could have been deadly, guys. You could have gotten to the top of this on the Nasdaq and just rolled. Now, a lot of people will say, well, what they're doing is they're going to take us over and then they're going to roll again, and this is going to be a right shoulder. And I see that. I see what people are saying. Right shoulder, head, or I'm sorry, I apologize. Left shoulder, head, right shoulder. I get it. I just don't know that that's what happened. And I don't try to predict. I try to make decisions based upon what I see happen. In other words, I try to make decisions based upon probabilities. Not every time that you're forming a base does it become a head and shoulder. Sometimes you just form a base and you go higher. So I think we're better off assessing this and letting it play out. And if we look at some of the core data, for example, if we just overlay RSI, RSI broke 50, tried to get through 50, couldn't, and then broke above it. So here on the daily, we couldn't get above it. And then here we are now above 50. At the same time, I'm curling up on the 12, and my 55 is pointing up. I'm not saying that you can't roll over, but you have a lot of spots in here now that you're going to hold. And we're going to get into that on a couple other names as well that I think it's really important to look at. For example, what happened with Tesla, and we're going to talk about that in a moment here. But if we drill into this, let's get rid of this and we'll start over on the weekly, and we should look at the rate of change and see how that's going. I do appreciate all your comments and sharing of these videos. It helps me greatly with the algorithm, but more importantly, the sharing, you are making a difference because people are getting them, and I am getting emails from people. So please keep sharing these videos. It's helping people greatly. I do want to point out a couple things before we get into rate of change and where we are with the moving averages. I do think that we should just point out that this was a battleground, this 15.279 area. This definitely was a battleground area. We couldn't get over it. You rejected here. This became your control bar. You broke down, right? 1, 2, 3 up, and then we hook. Everybody that watched that one candlestick video knows this is a bearish hook reversal. You can see the break and just the straight down, just the straight carnage from there. Tries to make that higher high right here, rejection, and then you have this little megaphone here, and then it breaks. And then, of course, everybody remembers when we had the peak CPI number, which was the bottom of the market. You didn't form sideways, you rally back up. All right, so this is where we're at now. And the point I'm getting at is since here, you weren't able to break out. Well, you formed a base, and under here, what were you doing? You were eating up what? You're eating up the supply here. Why were you eating it up? Because you had demand. Broke out, unable to lift. This is interesting, this part of it. Broke out, unable to get a higher high close. Unable to make a higher high close. Breaks down, we get the bearish engulfing there. 1, 2, 3 down, inside, right there. Not true inside, but you get it. And then we flip, bullish hook. All right, so now we have a bullish hook reversal here. Well, this makes your life really easy. You want to know, people always say, well, when is the trend busted? When is the trend truly busted? Stay below that level for a couple weeks and you are truly busted. So this is a weekly chart. So you want to be down there at least 3 bars. But if you break that 14.6 and you stay below there, you're pretty busted. Number one, you're going to have a couple things going against you. You're going to be below all these moving averages. They're all going to start sloping down at this point, right? Because they all caught up. Remember, when you were up here, none of these averages caught up. They're all catching up now. And that's definitely a major, major distinction that we didn't have before. So that's the first thing. You would want to watch something along those lines. This is on the the daily, but here, let's go take a look at it on the weekly so you can see. So if you got to that 14.6, so you're already caught up to the 12, you'd be below the 12, you'd be below the 22, and you don't even have this till 12.9 down here. So you'd have a real problem on your hands if you start breaking this on the weekly. That is definitely something that you need to consider. It's certainly something that I'm considering. Now, one of the things we look at, and we've been looking for the past couple of weeks, we've been talking about this breaking the rate of change. And every time you break that rate of change, what happens? You get underperformance. Well, that's exactly what's happened since there. And we mentioned that we don't want to stay below the zero line, because if you do, that's when you get these major little, no, I won't call them little, you get these sell-offs. And you had another one here as well. And every time you break that zero line, you should be able to see that. You don't want to be there, and it's pretty rare that you do. So when you get above it, you definitely want to be paying attention to it. And you can see how we're acting right in here. We're starting to push over. So I wouldn't rule out that we can come back up and test here. I do have some concerns, and I'm going to address them. But this is something that, on face value, it's very hard for me to look at this and say that rate of change is a problem. Now, if we look at MACD, just to get a lay of the land, which I do like to use, we flipped here and we have a cross. Well, that cross is still in charge until we figure it out. In other words, if we come down more and these start to widen, that's going to be a problem. Now, they're getting a little tighter in here right now, and so I can't really say that, yeah, we're definitely going to pull one of these. What we might be doing here is we might be doing something like this, where we just start becoming a non-event. And I don't know if that's the case yet. We have to go sideways for that to start happening. And we might start doing that, because that's what happened last time we were up at this level. If you take a look at this level really clearly, I just draw that line as a level there. You see what I'm talking about. So that's definitely something that's of concern, but I pay attention to that. If you take a look at this on the ES, you're going to notice that we did the same thing, where we're not really breaking down. We're just sitting there. So it's something that I'm fully aware of, and it's definitely something that I would be paying attention to. Now, again, what we're doing here is we're following up. And please comment below, but I think that this is a really good idea. We're going to start this over so that for newer people that are not aware of how to utilize this. So below is the McClellan Summation, and what I use it for, summation is formed off the oscillator. It basically measures it. So I'm not going to get into all the details as we did in the previous video. I could probably cut out one of the clips on it, but for time's sake, I'm not going to get into it all. Bottom line is what I do, and this is how I utilize it, is I first look at the level we're at. So I look at this level, and that helps me make a decision. So in other words, what I'm looking at first is, where am I? Am I up here when I make a cross? Okay, so if I'm up at this 500 range roughly, that's something that I want to pay attention to. If I'm making a cross down here, does it have the same validity, or let's refer to it as umph, as it's going to here? Not really. So this is the level that I want to look at and pay attention to, just like some of the other indicators, which we'll go over in a moment here. So if we look at this and we can see that happen, what we would do is the following. We would just mark off those levels and go, okay, well, here's 1, here's 2 at that level. And I think we just went through number 3, okay, August 1st. And behold, we did just go through number 3. So what's transpired in that time? Well, every single one of these guys, I mean, you can see already, right? Before you get to the next clip and roll over, what's happened? Well, from this one we dropped what? 12% on the New York Composite. From this one, we dropped before we crossed, which was right here. We dropped 9% on this one. Let's just take a look at that. We dropped 4%. So the question would be, do we have to drop 9%? I would actually argue that no, you don't. What I would argue is that this is pretty interesting, that if you look at the depth of this, right? I'm always looking for patterns, right? I'm a pattern trader, and I know people say don't draw a line there, but I don't really care. I always look for patterns. And the thing about this is, what I find fascinating is, this was a 12% drop, this was a 9% drop, this is a 4% drop. Is that drop going to hold? Well, look at the depth that the summation went to in each of these occasions, right? And look at how that changed. So just to make this simple, I'll throw that up there. And then if we just mark off these as demarcation lines, just so you can see what I'm talking about, just mark them off that way, you can see that all they're doing is just walking us up, which is exactly what you want if you're on this side of the trade. So if we can see that, then we know that. Okay, so let's get rid of that for a second. And let's take a look at what's happening now and seeing if that could give us any indication. Well, here's a cross under the 0 line. Here's another cross under the 0 line. And here's another cross. Well, there's one here too, isn't there? But yeah, well, we have that there too. So let's mark that one. And then here's another one. Now, why we probably should take this one out for the sake of argument is because we never achieved the same entry point, which was that level of 500 above. So if we look at this over the past year, we've had this signal 3 times. How has this signal done? Well, we would use it to the first cross, or we could use it to the first 500. Let's just use it to the first cross. Okay, let's not get greedy. So we're going to use it to the first cross, which is right there. So that gave us a 17% return. Let's do this and see what this gets us. Oh boy. So I got to come up here and go, all right, so from here over, and that got us a 7% return, okay? And then we're here, and we know it's a 7% return. Now the question is it going to be more muted because we didn't drop as much? And the answer is maybe. So let's take this and realize that that dropped off the way that it did. So maybe what this is telling us, and I'm playing devil's advocate here, I don't know this, but if you take devil's advocate and you look at the drop, okay, let's just say that it's going to be the average of these two to make it simple. Okay, so that would put you at a level where this one, again, just so you remember, if you come here, that one was, we'll call it 8. This one we'll call 18, 26. So let's just make it really simple here because I don't think that we want to say double digits. So let's just say 9%, right? Let's take a discount to it. And so you say 9%. Okay, well, that puts you at, okay, if you just say that it's going to be half of this one, if you just want to say, well, I want to be conservative, it's half of this one because you're down here at 870. You can see the line going across, and this one's at 380. So that's half. So I've had half the drop. Therefore, we're going to take half of that. All right, let's play that. And let's go 3.5%. Oh, that puts us at multi-year highs. So when I look at something like that, that is something that is worth us paying attention to. One of the things I get asked to do a lot is to follow up. So that's exactly what we're going to do. And it's a very interesting time to do this. I'll show you why, but let's go through it for everybody that's new. This is smart money. We do not refer to it as smart money on this channel. We refer to it as institutional money. This is dumb money. We do not refer to it that way. We refer to it as retail. We do understand very specifically that institutional money has more sway than retail money, but that doesn't mean that institutional money is always right and that dumb money is always wrong. So we need to keep that into account. One of the things I say a lot on this channel, and it's really important you get this concept, when you understand what these oscillators, these indicators, what they're actually measuring, you can benefit greatly from them. So we're going to look at smart money, dumb money, a couple other indicators here that are absolutely glaring. And this is Sediment Trader. I have no affiliation with them whatsoever. It's a service I pay for. I did reach out to them before I even do these videos just to make sure they were comfortable with this. They said fine, that they know that I do this. But it's a good service and it provides some information that you might not get anywhere else, which is what I like. So let's just talk about this. If you're over this line, for those that are new, that means that you are pretty much giddy. If you're down here, you're pretty much doom and gloom, okay? Now, what I like about what I'm seeing is that when we're up here, usually peak retail, when retail has peaked, okay, that is usually peak retail is usually a high. And we can see that pretty clearly here, right? We talked about this a month ago and we've been following up on this. But when we see something along the lines of trough, meaning trough on the smart money or institutional, and we have this spread. Well, these spreads mark highs. The spreads can mark highs, except when the spread's inverted, where you have smart money fully invested and you have retail, which is how we're going to refer to it, and this is institutions fully invested. When you see that inversion, and I know this is a lot, but I want you to understand this before I go to the next stage on what I'm saying. If you see this kind of inversion, that usually marks a bottom. So why people will say, well, it's the differentiation between the spread, then this is where we get our edge. They're worried about the spread. What I'm saying is, not only does the spread matter, it matters who the spread is. In other words, if institutions are up at the top, well, that's definitely something that we want to pay attention to, right? If it's institutions up here, well, that really seems to be marking highs, not lows. And you can see retail down here saying, not today. No, we're not getting involved. We're okay. And they get involved here. That's usually when you see a peak, and then they have all the buying power. Institutions have more buying power than retail. It's just a fact, it's just the way it is, right? They're the sharks, we're the remora. When we understand the dynamic, we can profit from it. So here we are. And we could see how we're tying in right on these levels again. Now, this is really kind of cool, or maybe it's just cool to me. But so we got close together where we're going to flip. And the majority of time you flip, and institutions will come up here, and retail will drop. Well, look at what happened here. All of a sudden you touch and then you reject. So that's a pretty interesting statistic move for me because I don't see that move that often on the chart. So if I'm going to look at this chart, now we're going to zoom in on this on a 1 year chart, and I'm going to show you this. And you look at what's happening right here. And then you go, well, how many times has that really happened on a 1 year basis? Well, it happened right here. Okay. And what we want to focus on, I'll be real clear about this when we're looking at this. I'm focused on a couple things. The very first thing that I'm focused on is that I want to know, is it institutions that's on the bottom, and it's institution on the bottom, and then is it retail on the top? I don't want to find an inversion where it's the exact opposite. I want to find out as close to possible as what's going on. So what happened here? Because that might tell us what's going to happen here. Listen to the words might. So then we come up and we just see, okay, well, right here, we had a little pullback, and then we just started running again. All right, so if retail starts getting back into the market, what tends to happen? We tend to go higher. If retail gets back in the market, we tend to go higher. All right, well, that's interesting. That's something that we should be paying attention to. But maybe it's just, it's just this one time. So then what we do is we go back through time and we take a look at this. Now, fortunately enough, if we look at this data, you can go back 20 years. You can go back, frankly, all the way to about 23 years. But let's just go back 5 years for a second and take a look at this data and go, well, what we're looking for are situations like this, exactly like this, and seeing how many we had in 5 years. And the answer when you look at it is not many. So we don't really see many more in there, right? We see something similar during this period in time in July. So what we would do is just maybe we'd zoom in on that period to get a better look at it and see if we can find something or learn something from that period of time and see if it's similar. Well, this is kind of similar in here, and we'll squeeze this back a little bit so we can really blow that up and drill in here and then go, okay, well, that is somewhat similar, and it's similar in the standard of, well, we kind of flipped, and then after we flipped, what did we do? Well, after we flipped, we kind of did the same thing, and so you go, okay, well, let's look at that, and you're right in here, and you go, all right, well, that's that right here, and then we went higher. Then we tried it again, and then retail bounced higher, and that's right here. Well, then we tried it again right here, and then we went higher. All right, so there's 4 times. Well, maybe that's just what took place in the past 5 years. So maybe we shouldn't, get too into that. So then we take a look at it and we go out 10. We go, all right, let's go out 10 years. And we just went out to 17. So what we'll do is we'll go from here and we'll just drill this back and we'll take a look from, let's go from 16 to 12 for now and see if we can find any. And then we'll just drill into here and see if there's anything in here that remotely looks like it. And we really only see one that I see that's kind of glaring, right? Actually, there's 2 in there, isn't there? Let's look at these 2. Let's look at what happened on July and January and see how that played out. Now, the first thing you're going to take by me doing this is a couple things. Number one, you should be taking this account. See right here? See how you stopped right there? See how you hit right here? See how you stopped right here? So what are we doing? We're drawing back through history, as past performance is not indicative of future performance, but guys, it's all we have. So we have to deal with all we have. Now, if we go back into this, we can go back into 15 and we could find another one. I believe I just saw one in here. I'm kind of doing this on the fly while we're talking, but I could have sworn I just saw another one right here. Yep, there's one right there. So then we go and take a look at this and go, okay, well, here we are. And then here we are again. Okay, did that mark a top? It didn't mark a top. Did we go a lot higher? We didn't go, let's say it this way about that one. We didn't go down, okay? We didn't drop and we didn't go down. And I think that's the better way for us to look at it. And the other thing you want to talk about too, and just so you get it, we're only looking at the ones where you're coming up off the bottom, all right? Which is exactly what we're going through now. Now, if we drill into this again, I just want to go back a little further. Here we are again, 2005. And you can see right here. Now, did we go up a lot more? We went up some, but what did it do? Well, it clearly marked the bottom. So the one thing that we can say, and we've gone back about 18 years so far, the one thing that we can say for certain is that at a minimum, it's marking a bottom. Now, just to go back a little further, and then I really want to get into New York Stock Exchange margin debt on the percentage of growth and what we're seeing from corporate insiders. But if we take a look at this and we just go back one more time, and now we're back 20 years. Now, what's interesting about going back 20 years on the same indicator that we're showing is this particular pattern. This is back when the Fed was not really intervening in the market as much as it is right now. This was not a zero interest rate environment. This had none of those things that are associated now, and it still worked. And it still gave a real indication on what was going to happen. And you can see how we went higher here. I think this is very important, and it's happening right now. And it's not something that I would sleep on or ignore. Now, one of the things I like to do, New York Stock Exchange margin depth, one of the things that we focus on is the percentage of growth. I want to know if it's growing, what the rate of change is over 12 months. This is going back 10 years. What I'm going to just simply point out is not the break below the zero line, but the break over the zero line. So I'm interested in breaks over the zero line. And then how do we act from that? Why am I interested in that? Because we are doing what? Breaking over the zero line. What does that mean? It means the rate of change of margin is no longer being negative. Means it is being positive. Okay. If you are below this level, that means you are declining in your growth of New York Stock Exchange margin. Over it, you are increasing that. You can see where we would peak. You could see where we would trough. All right, it's not rocket science. If they go out there and borrow money, they're going to buy more stocks. They're going to buy more equities. It's just the way it is, hence New York Stock Exchange. So if we take a look at this and go, okay, well, we broke up here, and then we kind of mark up here and go, well, we did pretty good from there. We had a nice little run. All right, so then we kind of look at it again and go, well, we had this, and then the pandemic hit. Okay, so maybe we have to kind of not really pay attention to this one as much, and then we go look at the next one. I go, okay, well, this is when they started levering up. And then you're somewhere right in this area right here. And then here we are again. Okay, so we've had this indicator go off 3 times in 10 years. And both other times that it's done this, we've gone higher on the market. All right, so that's interesting. Let's go out 20, see if we can find anything else that would be of substance. Well, the very first thing that comes to mind by looking at this is going to be that we see a situation where, well, we have one right here. Okay, well, that's the great financial crisis. All right, so that's when we delever, the great financial crisis. All right, so that did fairly well, marked an area. Here's 1213. Well, that marked an area. And then we just kind of go through it. Well, we held there, so that's not really one. Then we go to 17, and how did we do in there? Well, that marked the bottom. All right, so now we've gone back 20 years. We have an indicator that has gone off 1, 2, 3, 4 times. We're setting up the 5th one in 20 years. And every single one of those has done what? At a minimum, it's marking a bottom. Something to think about. Corporate insider buy sells. Why is this? This is a ratio of corporate insiders, whether or not they are buying or selling their stocks. Above here is really optimistic. They are buying the living heck out of their securities. Down here, they want nothing to do with them, and they're trying to sell at every turn. A lot of the time we are listening to people talk about there's going to be a credit event, or there's going to be a massive recession, or we're going to enter a depression, or we're going to have some type of major cataclysmic event. In doing this for over 20 years, I'm just going to say this. The only time that you have an event is when you're not aware there's an event. If we're all talking about an event, it doesn't usually happen. This graph that we're about to go over is somewhat indicative of that. And I'm going to get to it in a moment, but I want you to understand that. And I want you to understand that when I go through all this data, I'm analyzing data. I'm not making decisions. I'm analyzing data. I'm not making predictions. There are a lot of other places and a lot of other channels that will make great, massive predictions. That's not what we do here. What I do is I interpret data, and then I utilize that data to make better decisions, whether I'm day trading, swing trading, or building long-term positions. And I do all 3. So if you take a look at this data and what this is telling us, this is corporate insider buy-sell ratios of financials. Well, who in the world is going to know more about their company than financials? Who's going to know more about financials than these people? Is there anyone? I'm trying to go back as far as I can. Okay, no one is going to know more about the financials of the financial companies than the people that are in there. I'm trying not to laugh when I'm saying this, but what I'm getting at is, do you think that they would see cracks like maybe in the mortgage bonds? Maybe like they did in 09, and we can't really go over here, but I'd love to see that data. I mean, they knew what was coming in 09. Believe me, they knew. So then you go back and you look at it and go, oh, well, we're all waiting for the end of the world here, right? Here's finances. Nobody wants to buy them. Corporate insiders couldn't buy enough of their own stocks back then. You couldn't buy enough of them. So it's really hard to compare this to that. What I would say is, as we're over here waiting for a credit event, a month ago, I'm talking about Japan and how that could affect rates and how inflation can go higher. What are the insiders doing of this company? Okay, and let me just be real clear about this. This works and it's worked since the US stock market's been around. You follow what the insiders are doing, then you follow what the institutions are doing, and then you follow what retail is doing in that order. That is the order. That is the pecking order. No one's going to know more about JP Morgan than Diamond, period. It's not going to happen. Think about it. So if those guys are out there buying, which they are doing right now, and they are buying at a level that is higher than pretty much anything besides what we saw in 17 and the great financial crisis, they're actually buying more financial names right now than they bought during the pandemic, if you take a look at it. It's very difficult for me to look at that and say that there's some kind of credit event or cataclysmic event out there and that every bank is just not aware of it. And I think that's a very important distinction. And I think that's very different than when you saw here, where they were basically getting out of the stocks in 23, and then we just happened to have a major problem when, right? So if you think about, let me walk you through what I'm getting at. In other words, look at when they're selling. Look at when banks are selling, right? That is the lowest that you're going to get to. Look at when they're selling. What happened to us after they sold here? What happened here? Regional banking crisis. So they just happened to know a month ahead of time that they need to get the heck out of their positions. It was just a coincidence. It wasn't in the papers. In other words, they knew they had to get out. They got out, right? Now we're all talking about which bank's going to fail, and what are they doing? Buying at the fourth highest time on record. Something to think about. Inverse ETF volume. So what this shows you is if they're out buying bear funds, you want to buy SPXS, that kind of thing, SQ. And it just shows you how much volume is in those funds. I just thought this was really interesting, so I wanted to point it out. In all of history, we just experienced the highest buying volume of bear funds out there, period, that are inverse funds in the history of this data. And you can see it increasing on the volume side. Why is it increasing on the volume side? Well, they came out with more and more of them. But when you start seeing a peak like this, I just think it's interesting and something to pay attention to. Maybe even a contrarian indicator. We'll find out later. We'll find out in about a month. One of the things I like to do is just review the health of the market before we get into ideas. I want you to just understand where we are in the pecking order. So this is S&P stocks above the 20-day, and this is a short-term indicator, but you will note that every time we get to 90, that we have some kind of pullback. It is not unquestionable for us to have that. I would want to point out one distinction that I'm noting here, and this usually leads to higher prices, and I thought it was worth pointing out. See how we're making these higher lows over and over again? Now we didn't here, we actually undercut. What's fascinating about this and why you want to look at these is you want to look for extreme readings. And what do I mean by extreme readings? So if you're looking at this, and let's just say that you're at a 9, which seems to be the low end of this reading, that would mean that 91% of stocks are below their 20-day moving average. Probably not realistic for that to stay that way, as it's not realistic for 91% or 90% of the stocks to stay above their 20-day moving average. So you're in that middle area, but I look at this as a way of just, hey, what's going on out there right now? Where are we? If you look at this the same breath, and we talked about this about a month ago, when you get up here in this 90 on the 50-day, it's rarer because that's an institutional level, but when you get to 90, that's it. You usually have some kind of pullback for some reason. It could be because, butterfly flaps its wings. It could be because Powell speaks. They'll find a reason, right? If the market wants, they'll find something. And you can see it here. And I'm going back about 2 years. And I'm going to be real clear about this. I'm going back 2 years. And you can see that we've been here 1, 2, 3, 4, 5 times, right? That's why I'm bringing this up. But hopefully you'll see the distinction on what's happening here. So during this period of time, and here, let me wheel this back so you can get what I'm putting down. During this period of time, what were we doing? Well, we kept hitting higher highs as we were bonking our head up. All right, well, that's interesting. That means the breadth of the market's getting stronger. Well, what were we doing when the market was going down? Well, when the market was going down, and we all know the market was dropping during this part, and we all know that the CPI popped right here, and that peak on CPI was the low of the market. Well, when the market was going down and we were trying to get up here, we were having a harder time, and we kind of kept hitting lower lows. Well, that's interesting. Maybe that's something we should pay attention to. What are we doing now? Well, we're starting to hit higher highs again. What does that mean? What did it mean last time? Just a data point, something to think about. Again, what we do here is we analyze data. We don't make just prediction based upon the data. It's a data point. And this is a great example. This doesn't get any cleaner as an example. So I'm going to take all that off. This is a 5-day. And this is percentages on a 5-day. And I want to explain this. This is free. You can go here for free, right? You don't need to pay for a fancy indicator. SFD, you can pull these all up, right? They all start with S5D, 5-day, right? It's not rocket science. TW, 20, all right? So just it's not. They all start with S5 if you type it in. So what's so fascinating about this one is this is a short trigger. So what do I mean by a short trigger? Meaning that if you're day trading or you're leaning one way or another, if 95% of the stocks are all above the 5-day moving average, you may have a problem. And that's what we saw happen the other day where everybody was giddy and then we kind of have a little bit of a pullback and now everyone's like, oh, well, that must be it. Or we're just going to revert back down. So how you use the 5-day is this. All you would do is just say, okay, when we get down to this level and we get to where 90% of the stocks are in a position where, and this is the 16, 17, 90% of the stocks are in a position where they are dropping, that might be something that they're all below. So maybe just put like an alert there, something to think about. Maybe you put an alert up here if you ever hit that level, and you just put an alert up there because you can see that sometimes you get a little higher up in this way. So you just want to know where the extremes are, right? So that's definitely something that you might want to pay attention to if you're a short-term trader. You'd see we bounced off of it and go look at what happened on this particular date on the market, and you'll get a sense of that. I mean, that's almost like roughly where Powell spoke, right? I mean, we know this. And that also kind of did what? Kind of marked the bottom of the market. So something to take a look at. I mean, it's not a coincidence that you hit there right on the 18th. So keep going into this. The number one of these that I look at is this, and this is the be all end all. This is like the queen bee, 200-day moving average. I said if we break 50, you want to get out of the way. If you go look at the times that you break 50, you underperform the market. What did we do? We hit 50 and we bounced. Okay, all of these are very simple indicators that anyone can understand, and they're all listed right on TradingView. It's up to you. I mean, you can actually do it for free. One thing I would just note that we finally stopped selling. This is VTV versus VUG, and you'll note that we kind of pulled back here, right? And we've been selling value. And I just look at it from that standpoint lately, like, oh, we're selling value, and that's something to look at. And I've been looking at the Qs versus the S&P on a relative performance basis. I'm just going to say this, guys. I know I keep hearing about this, double top and this head and shoulders. This looks pretty similar to a head and shoulders, right? Doesn't it? Or does it look like a base? Because if you can tell me what that is, you're smarter than I am. I don't know what that is. To me, it looks like it's a base that tried once and may try again. And it looks to me then the Nasdaq might outperform the S&P. We're only going to find out in time. But let's get into some names because there's some things out there that I really think we need to pay attention to that I think are very, very poignant. Now, I do want to point something out, and I do think this is important. We came down, tested the 200, and held the 200. We've never done that before. Now, you're going to say, well, a lot of what you're showing me today is conflicting. I don't care. It's not my job to put a story together that makes you comfortable and feel warm and fuzzy. It's my job to present data so you can make more informed decisions. I don't want a higher dollar. I just don't. First, it'll kill industrials because the cost of goods overseas is going to be an issue. It'll hurt names like Microsoft. But we tested right in here, and we held. And we need to be aware of that. And I want just to get that out there. Now, I'm going to point out a couple things that I liked and a couple things that I didn't like. Number one, I didn't like what Tesla did. I did not like this action on Friday at all. Now, I didn't like it for a couple of reasons. Number one, I had a position in it and I wound up losing money. And despite how people are on here, there are no gurus and people put on trades and they lose money. So it happens to me just like everybody else. The goal is to cut them fast and then move on with your life and then hold your winners longer, right? Don't overcomplicate it. So you come right in here and it looked like to me we were going to pop over. So I got in that day. Was there some telegraphing that there might be a problem here? There was a little bit of it, but not excessively. Now, if you look at this on the weekly, I have this doji, and I'm not really crazy about that doji. Let's clean all this off for a moment because I want to drill into some of these charts. There's a lot going on here. I don't like that this is not able to close up 50% on the bar. I don't like that I have a doji sitting right here and it was absolute rejection. I certainly don't like that I couldn't get above there. Right, so does that change my thinking on the trade? Well, this is the way that my thinking works on any trade or any stock that I'm trading around. And let me be really clear. If you're building a long-term position in Tesla, long or short right now, you are smarter than me. because I cannot look at that and tell you that you have a direction. You don't. If you had to pick the true direction right now, you'd have to go on the weekly and say that everybody should be shorting the name, because that's the true direction. We can see the DTL is unable to break. The problem with that is you have a change in trend here, and we can all see that. So this is setting up for the mother of all pinches, and what I call a kill zone. I mean, you can see something's coming, and I don't know what it is. Now, there's a lot of speculation out here on what it is, and we can talk about it, but and this is the thing that got me. I don't think it was the third price cut. I think it was them on Friday. I think it was them actually getting rid of models they were going to roll out weeks after they said they were going to roll them out. That's a problem. But from a technical standpoint, and where we are, if technical is a word, we are right here, and we look at how we're holding in here. That was nasty. Okay, and we rejected. Now, is this 22.12 cross? Is that going to hold? Did we hold the 22? We did. So are we going to fill in here and then push? I don't know. To me right now, this was pretty clear. I took the loss. I bought some puts. I made a little money on the puts, not enough to cover the loss. It is what it is, and on to the next one. And I had other trades that I did okay with. What I would say, what I'm noting more than anything, is if you're getting to these 55s and reject, I want to pay attention to that. Yeah, that's a big deal to me, and I'm gonna point this out again. We got to this core level, and we're rejecting. Now, people say, well, it's Friday, it's light volume, and I agree with all of that. I do. I agree that Friday, light volume, you're going into a holiday weekend, don't overthink it. Absolutely. I have a gravestone here. I told myself on Thursday, don't overthink it. I have a gravestone, and we were unable to get above the 12.22 or the 55.22 cross. I use a 12.55 and 22. You should use what you're comfortable with. So then I'm like, all right, so there's this gravestone doji here. Well, it's Thursday, and we're going into non-farm payroll, so people want to be flat. So that's not a big deal. Well, now it's Friday. Okay, it's like, at what point you say that it is something? You can't keep saying that every bar is not something, right? And even I have a problem of doing that, where you look at it and go, well, it's because of this. Well, I don't care why it happened. It happened, right? So I have to, sometimes you have to kind of take a step back and look at it from that standpoint, just like everybody else does. And the bottom line is, let me clean that off. The bottom line is, when you look at this, that does not make me feel warm and fuzzy. This was your control bar. You broke. You couldn't get above it. We're having trouble getting through that breakdown as well. Is this my week? Everyone keeps telling me, don't worry, the PE's low. Look, I tried to rally. I reversed. I cracked. I could never get above it. I could never get over, if you clean all this off, I could never get over that right there. Okay, never could gap fill. Never could cover that gap fill. And that's a problem. And I need to see where that's taking me. So I don't know if we're going to see rotation, because the XLK is back to all-time highs. And you'll say, well, it's not all-time highs because you're here, right? And we know that this index is 45% made up of what? Apple and Microsoft. And we just talked about the dollar going higher, which really doesn't benefit Microsoft at all. But if you take a look here, we're still back at all-time highs. I mean, if you didn't have this here, right, and you just happened to cross, you'd be giddy. So you kind of have to put it in perspective. All right, so we have this, and are we going to get through this, or are those people going to sell? Not a clue. I know a lot of people are pounding the table on Apple. We're going to get to that in a moment. I do want to point out some things that I think are absolutely glaring, and I'm wondering if we're seeing a shift in the guard. And I'm going to explain what I mean by that. So instead of seeing the Amazons of the world keep pushing, we seem to be seeing a little rotation in some of these names. So like, for example, Shop, and we come here and take a look at this, 1222 cross, RSI's pushing above the 55. We're in this minutia, but on Friday, we didn't go down. Shop did not go down on Friday. Amazon went down. Now, I'm not comparing them for what they are, but I'm saying that, are we starting to see a shift more into some of the smaller names? Are we hitting that point in the cycle where this is becoming a stock picker's market? And if it becomes a stock picker's market, well, we know what that means. It means that we need to go with the smaller cap names where we can understand the fundamentals and we have an edge. And then I'm going to pop this on so that you are not tortured by what? My childlike drawings. So some gentleman gave us this, and I appreciate it. And we know that there's a macro, and when we look at the world as a stool, macro, fundamental, technical. Maybe I'll put the tags right in there so I don't even have to say it, and then just leave it in there. But looking at that, that's going to lead me to start looking at some of these smaller cap names, because they're going to turn more on a dime. All right, so we kind of have that piece of the puzzle. So then we drill into some of these larger names, and we take a look at NVIDIA. Let me be real clear here. I have a position in NVIDIA. I took another position on Friday on the long side. Anyone's going to look at that chart and say, what are you thinking? I got a really good price on it. I'm pretty happy with where I'm in on that. I can't really say enough about it. So I'm going to hold on to it for now and just see what happens. If I take out the lower low, that might just be the end of it, or that might give it some room to hang itself. But with these moving averages pointing up with what I'm dealing with right now, the fact that I can't even break, the first, I'm not even getting a hint or a modicum of even breaking the first level of any type of support. Like, what's my hurry to get out of that, right? To try to get back in. I was happy for the sell-off. It gave me a good spot to get in. And then you look at this on the weekly. You want to get out of that? I better get out of that. It's hitting all-time highs with all-time high closes. I better get the heck out of that before I pay capital gains, right? Like, what's my hurry to get out of that name? Now, I see this, and I'm sure everybody else does as well, how you keep coming up, hitting these levels, and you keep rejecting off that. I'm sure everybody already saw that. And you can kind of come here and just look at the major one, right, which is up here now, and you can see how you hit that again and reject it. All right, so that's an issue. We are over, and that's an issue, but it is what it is. I don't know how I'm selling a stock that's hitting all-time highs in this market when we're in a chop zone. Remember, chop zones are areas where you can have a problem. Why can you have a problem? Well, you're in a chop zone, and it hasn't made a decision. And some of these names are going to make it and some are not. Now, I don't know why Meta's doing this. I just know that it's doing it. But let's talk about what we're seeing. MDB, this was a really good quarter. And what happened again? So I go back and I look at earnings, and we go back to this earnings date. And why can't I close above that earnings date? Well, these people want out. I mean, it's that clear. If you get rid of this, they went out. I mean, that's very clear. This is about as bearish as you can get. We sold off. I actually had a trade in this after hours, and I did okay with it. I actually walked through it a couple days ago. I'm not going to do it again. But when you reject like that, man, you got to pay attention. You need to pay attention to that. I mean, it's not great. It's not ideal. You look at that weekly chart, and you're like, well, that's not a big deal, isn't it? You couldn't break this bar. You couldn't break the top of here. It's not a big deal. Sure seems like a big deal, right? So something to think about there. And troubling, because why is that troubling to me? This was a blowout, man. This was a blowout quarter, and so was this. So I'm a little concerned, but maybe all we're seeing is just some weak hands there. I'm going to talk about the old guard here. So I feel like I'm in the 90s. Why? Intel's coming out. They actually did this conference where they showed their chip next to NVIDIA. I don't know how they ran this, but there's a video floating around about it. It actually performed quite well. There might be some likes to this. You might see some positive comments coming out of investment banks on this. And then when I start looking at this and what's happening, and we're getting above key levels, and this is really fascinating to me. When I looked at it, here, let me pop that in. There's the 200. Like, I can't remember the last time we did this. Like, where we had a 200 that's starting to curl up, and all these are pointing up. Even if I got rid of this, just look at this and look how fast, well, I think it's fascinating, but I'm a bit of a nerd with tech. Look at this. When was the last time we did this? Back here. All right. I mean, you have to go back decades to see this. Like, you don't have this like you have now. And you're at a major inflection point. Major. Like, you got Matumbo twice here, and you're going for your third. So I like this a lot. It's definitely on my radar. I would suggest that it's definitely something that you take a look at as well. And again, this is why I feel like I'm in the 90s. So this is something that we did a day trade in the room, and I pulled some money out, but quite frankly, I was so enamored with some other names off the open that I didn't get the full effect of the move. Now for me, and I'll just give everybody a quick tip, when I start having like a 99 or 100 on a 1 minute RSI, even here, hold on, let me show you. Even here, like I had like a 98 on a 5 minute. Very rarely will I stay in that trade. Very rarely will that continue to live. So I started scaling out of it, even though I like the name a lot and I want to be in it. I added to it end of day, just disclosure. And then it came back like about $1, $1.50. So I trimmed some, but I'm riding with some. I would read this report. I would listen to what they had to say about their earnings. You don't do this and you're going through a recession unless these corporations and it's all corporate buying. And I want to be clear about this, because when I say we're going to the old guard, I just showed you Intel. We're looking at DELL hitting all-time highs. Look at this, IBM. Look at this. Like, this is crazy. IBM, all-time highs. Well, who's that for? Well, that's corporate spending, right? You're not going out and buying an IBM laptop. Well, maybe you are, but this is all corporate spending. Well, what else is corporate spending? Oracle. Didn't UBS just come out and upgrade them? Out of nowhere. No comment, out of nowhere. UBS upgraded them $20 target from here at 140. So we're missing something, or let me rephrase that. I'm missing something. And then the other thing I'm going to go back to, and I think that this is really important, is we're starting to see like some of these not hold, right? So CRM's not holding, but crowd's holding. This is a trade I did. I'm going to leave all that in for the educational class, but I'm not going to take it out. But you see how you're in here and how you're coming straight across? I would pay attention to some of these names that are starting to have curling 200s. Right, so I'm wondering if we're going through a change of the guard. Okay, well, maybe AVGO was good, but maybe it wasn't that great. Maybe we have to into this price point. And then we start looking at names like this. AFRM. Well, Goldman's out pounding the table on it. I've got a 200 starting to curl up. So, all I've been doing is day trading it, holding it after hours. And now I have a decent position in it, but still, like, where's this going? And so then you start looking at that and going, is it the next UPST? Someone's going to say no. All right, well, maybe it's not going to do that, but maybe it is. So maybe put it on your radar. Then we look at CVNA. I had a day trade on this the other day and was able to get a position off at like $43 down here. And look at it. Now we have to get through that control bar. So we're starting to see the smaller cap names that were beaten down rally. At the same time, I'm watching Meta crack, but I'm not really watching Google crack. And I think that that's an important distinction, right? So we're seeing certain names crack and certain names not crack, right? And maybe they're working into the price that they got. You start looking at something like Apple. I mean, Apple came all the way back. All the way back. And you're going into that conference. I don't know how that phone's going to work. I have no idea. But I would say that you are seeing a major shift out there. And I think we have to start looking at why we're seeing the shift. For example, AMAT, no one's talking about it. All-time, well, I'm going to say all-time highs, but it's really not, is it? Multi-year highs. The only time you were greater was when you were at the peak of the market. It was the only high close that you had 1 week. So you start digging into this. You start looking at these little guys like CRDO. Goldman was popping on this one this week. And you start looking at these names going, well, maybe it's not going to be the large caps. Maybe it's going to start being the small caps. And this is where it gets interesting, because if it's going to start being the small caps, well, that's usually the beginning of a cycle, not the end of one. That's it.